Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Welcome, everyone, to Macro to Micro Options Power Hour, where we are judging and chasing volatility both ways. Remember the days, Hans, when we had jump risk both ways? Well, we have got fabulous volatility both ways, and we're going to talk about it. Basically, Basent came in exactly at the 1 o'clock hour today, Treasury auction, which was fine, by the way, but very strategically started talking the bond rally. And it was really evident because I have him on notifications, so I could see that he was timing it perfectly with the 1 o'clock auction. Anyway, long story short, it was also timed with Trump coming out 15 minutes later and basically removing the reciprocal tariffs on all but China, making the 10% still in play, the rest on pause for 90 days. So this is always the risk, which is one of the reasons we've talked about, and I know in every day in my trading room, even though we're chasing this up into resistance yesterday for that intraday reversal, which was gorgeous. And it was in fact the largest reversal intraday. I didn't know that, historically speaking, by about 0.2%. We had today the high that needed to get taken out, which is SPX 5264 is what I gave. And once we got and stayed above it, shorts just started to, basically cover the hedges, what have you, the chasing begun, because we had two macro triggers. One was talk, one was action. So I wanted to show something real quick with you because I thought it was kind of also part and parcel for the market drama that we have all the time. Literally, Trump is positioning people, loyalists as well, to take advantage of this, in my humble opinion. So right before the news, someone opens up very aggressive calls and they go up 21% in an hour. This is the zero DTE that everyone loves. And so the result was, not only do you have the Basent bond put in place, but you have the Trump equity put in place. So both of those announcements that it came out exactly after the bond market collapsed last night. And we can talk about that separately, but this is basically the short-term effort to try and save both equities and bonds alike. So this is your kind of after a market heat map, but I show this for clients in my live trading room, and you can see dollar got supported. That's kind of important. Gold as well. This is equities, straight up hockey stick, and then it continued. This is the Qs. This is SPY, obviously, because SPX doesn't, I don't have that after hours. But as soon as it got above that blue line, and actually before it got above that blue line, I had done a client post right at 1 o'clock because I saw the Basent talking points. He was sweet talking us. So it was really ironic that we got this follow through because of Trump, but it started with Basent, and also the 10-year yield stabilized. Remember, last night, this sucker was up to 4.5 and the 30-year was up to 5%. And it was the rate of change that breaks stuff. So in fact, this is why I'm kind of putting this together here, is because we had not a little bit of a broken bond market, but a lot of one. This was an update that I posted for clients going, okay, I see a VIX divergence. I actually sent it to you as well, Hans, for your thoughts before the 1 o'clock auction. And then, of course, that was it. But bigger picture, we have big issues underneath all of this volatility movement, higher big picture and lower today on macro triggers. Because last night, big kind of hairy problem is that we had a massive bear steepening rally, and the 10-year went from 3.9 US 10-year all the way up to 4.5 in under 4 days and a few hours. That's not normal. So this is when leverage unwind meets plumbing problems, meets sovereign bond shock. Anyway, there was a lot that was going on, and I felt compelled to stay up until 2 a.m. and post this for clients. I was not the only one. Clients came in this morning and said they traded it all night. So my adrenals are shot, and I'm really glad that we can come together now to kind of, I don't even know what, calm down. I have not yet had anything to drink. I will. But this is the mercurial markets. Volatility both ways. You've got to be on alert for any macro trigger that can sweep it higher, sweep it lower, and it's a lot of bloody work. Would you agree, Hans? And last but not least, since I'm Samantha LaDuc, founder of LaDucTrading.com. I usually do that first. And this is Hans Albrecht. And we come to you across, Boston to Toronto and try and figure out the market's next move. So hit it, Hans. What do you see in option flow?
Yes, coming to you from the North Shore of Lake Ontario. I would say the 51st state, but now I don't know. I'm going to throw out my copy of The Art of the Deal because Trump may have had Powell almost on the ropes. Almost on the ropes. He almost broke. Yeah, he almost broke something, which is what it was going to take. And then he threw us that curveball today. But good for you seeing that something was up. Well, we had Jamie Dimon this morning. That was sort of the first bit of positive that kind of, it was almost like a bit of a thawing of what had been going on lately, which was really kind of like getting hammered with a battering ram, right? Every day, just absolutely. We are not pausing. We are not even considering talking to people. We're not taking calls. It was very, very, the animosity was thick in the air. And so this was really something I still can't quite believe. I'm looking at that bar on my chart here, and that is phenomenal from 4,900 pretty much 54.80, whatever that is. That's pretty special. And when that news came out, we were about 525 on the SPY, and I said, you know what, I wouldn't get in the way of this because things got so negative. We had a VVEX of 190, which is basically full on crash conditions. I mean, there were some things that were completely, there were some indicators. I mean, look, the VVEX got crushed. That's the volatility of volatility. So just to make VIX more fun, we have volatility of volatility measures, and that's still 140. So I think there's probably still a little bit of room there. The downside VIX of 33. So some things were kind of stubbornly hanging in there, which of course would probably relate to some of the brokenness that was starting to happen out there. And then near the end of the day, I told some folks, I said, look, I wouldn't get in the way of this because we had the biggest rebalance. Remember, we always talk about the gamma, the synthetic gamma, these things, derivatives are the dog now, not the tail anymore. And so they're pushing things around. And we had the biggest, what could have been the biggest, I'm not sure, the jury's out, biggest rebalance in the history of these ETFs, levered ETFs, inverse ETFs.
Oh, I didn't know that. I didn't catch that. Okay, that's
massive.
To know.
On a move like that, there's a significant amount of stock that needs to be purchased. Of course, technology is kind of kind of driving the bus there on those as a whole. There are some other little things in there, some Bitcoin, a bit of Russell, things like that. But really, technology, semiconductors, massive tens of billions of dollars needing to be bought at the end of the day.
I have to show you a screen real quick just because you're talking about it and it's fascinating to me. Okay, so you were just talking about the leveraged ETFs that have to be rebalanced. So yes. I have down here this, this is my ETF scanner. So I have 100 ETFs and some of them are a little duplicate, but the point is I can see where the market is moving on a particular day and go with it. Clearly, you had this type of action going on. All of these double and triple ETFs, the ARCs, the MAG, whatever, all of them obviously leading, but everything was oversold. Everything was pricing in tariff and trade wars. This is the result, and not even individual stocks. This is how much the change was, and all of it was intraday. So yesterday it looked like the opposite. We gapped higher and then we sold off 5%, 5 point something in the SPY. Today it was, oh my goodness, look at all the ETF rebalancing. So yes, very smart. And your VVIX comment literally reached, and we haven't been here since the August convexity rally from the yen carry trade, reached and then came right back down. But look where it stopped. I have to point this out because if this was a stock, this 3-day is support. Even if it came down to the 8-day, which is that purple line, it wouldn't be so scary to kind of buy the dip. And we only came back down. We get back above 148, this thing could fly again. So the point is, it's still not reversed like all the way down. But it was really interesting timing because it did have this divergence that I sent to clients to say, hey, is this a little bullish divergence? This was before we went vertical, where VIX of NASDAQ was up 28%. VVIX was only up 9%, but all the other VIX short-term, the 9-day, the regular spot VIX, they were negative. So in the same way we do this kind of spot up, SPY green, VIX green is always kind of a precursor. In this particular case, we had VIX very red despite NASDAQ way, way, way offsides. So I think that was very interesting as it related to the timing of this bounce as well.
Yeah, definitely some signs of wackiness going on, which is the problem when trading really anything. You can get in the way of a freight train. VVIX, we were talking about how it was cheap in the 80s and it doubled. held. So here we are. What now? Now what, basically, right? So I think in the one sense, on the one hand, we're back to 5,500, which I think is an interesting place for folks. A great spot to maybe pick like a July position if you're nervous, you think this could go on, which it certainly is going to go on. We've just simply, I think what happened was we went from being completely disregarded, basically the team saying, listen, we don't care about stocks, to suddenly there's a chance they care. There's hope. There's hope that they care about stocks, that they care about things. And we did
they
talk
care about the
how
bond market, and the bond market broke
Right.
last night. Just there's no question. It was a massive financial stress. They did do something today. I'm sure there were also dollar yuan. China did a little deval there to kind of buffer. The countries were involved in maintaining whatever they had for semblance. And it was also the midnight, the strike of midnight is when the 10-year hit 4.5 and then came back in. So
is that right? Yeah.
Yeah.
Well, that was
capital rotation.
That was one of the biggest, I think, since 1982 or 1983, the biggest 3-day move in the long bond that we'd seen in a good 4 decades. So this is something. It was going to require something spectacular, and that's exactly what we got. Everyone thinks that the VIX at 50 is spectacular, and while it certainly isn't the norm, what you're talking about is really what happened, which is things starting to happen underneath the hood, where pistons are firing out of the side of the engine, and that becomes more of a problem, right? The Powell wasn't going to flinch for stocks going down. Trump wasn't going to flinch for stocks going down. But the best thing was when Trump came out and said, "I think you can buy stocks. They're fantastic buy down here."
That was not okay. That was market manipulation. That was not okay.
Prove it. Prove it.
Jay McBurney is posting in chat that Goldman literally made a U.S. recession call 12:57 p.m. right before the 1 o'clock auction, and then minutes later rescinded it.
Did they really rescind it?
Back.
No kidding.
So the market, if you're in retail and you don't know what the F is going on, you are really, really not alone. But yeah. I have some really strong ideas, and I posted those until 2 a.m. last night. Big picture underneath the surface. Jeffrey and I are a classical economist who is absolutely brilliant on all things fixed income, and fixed income is the second largest market after currencies, so it kind of matters. Treasury is, of course, the biggest collateral, so we really do care about that market. Anyway, he has some very strong words about fixed income dangers. This short-term little save, or whatever you call it, where they get their execution is delayed. You know what I mean?
Stay of execution.
Yeah. Remember, I'm working on maybe 3 hours of sleep. This is a deal where this is going to come back. So we're in fiscal dominance. He could go on and on. This is not our show, is not about the macro backdrop. I did an entire hour this morning in my live trading room while the market was frozen. I did my macro rant of importance. And then I said, okay, now let's go talk tactical. So what we're doing now is trying to position tactically with an eye on option flow. And it's very, very important that I just say one thing before you dig into your charts, okay? This market is not at all in control by dealers. Market makers have no control over this. This is all macro. This is all fundamental. This is re-rating of earnings. This is macro event risk. This is tariffs on, tariffs off. This is, massive financial stress within the treasury market and then beyond. This is yen carry trade. This is basis trade unwind. This is not a dealer show. When the market is consensus and going up, basically 80% of the time, dealers reign. They are the option, that they are the flea on the tail of the dog. Okay, but when we have correction territory on macro, this is where we have to totally focus, and why I have these guys on alert notification. Because whatever they say will then trigger the dealers and the algos and such. So just kind of keep that in mind. Right now, we can do our best to interpret option flow, but the reality is that we've got to pay attention to anything macro right now, especially Trump and Percent.
Well, it remains that this has been an expensive market, right? And so we're kind of in between these worlds. Basically, yesterday it was kind of, it's just kind of getting slapped. It's like sparring with Mike Tyson with your arms tied behind your back. It was like getting hit again and again and again and feeling like nobody's got your back. Nobody. Powell didn't have your back last week. Nobody's got your back. Suddenly there's something interesting going on, but it doesn't change the fact these tariffs haven't gone away. Okay, there was maybe a little bit of a concession there, but this hasn't gone away. And really the difference is in a very strong market, which at 6,000, 6,100 at 20 times earnings, you're pricing in perfection. And perfection doesn't just mean from earnings. It means you're being stimulated. You're being embraced by the environment. Everything's going in the right direction. If you head towards a little bit of a recessionary type environment, really what kind of multiple do you put on it? So it's not just that things, the E part of the PE goes down. You have a sort of re-rating as people bring down the multiples. And so what's appropriate? 15, 16. So I'm not sure a whole lot has gone away. So I see this as a little bit of a gift for now. If you hadn't sort of lightened up, maybe it's a chance to at least get on some hedges, given that volatility levels are very high. And when I say volatility, I just mean option pricing. We know volatility levels are high in terms of actual movement, but you're being given some pricing at the best of times is never super, super cheap. And right now, go ahead, Samantha.
No, I was just going to say, you're talking about protection, but we also have to, I've got to talk about the earnings because we're going into earnings season very, very soon. And
so if you're a CEO, Samantha, if you're a CEO, has today changed anything? Because the narrative yesterday was every single CEO is going to come out and throw his hands up or her hands up and just say, we're pulling guidance. We haven't got a clue, which is how everybody felt. We haven't got a clue what's going on in the world. Does this change any of that?
Unless there are guidance calls that are very positive because they're in the sweet spot of whatever is going to happen next in this new regime, domestically located with, great margins, and this is going to benefit them. And okay, they're going to be rewarded richly. The ones that don't give guidance are the ones we're still going to, hold down over here or hold our nose, depending on the time frame of the trade. But there's not going to be a lot of confidence there because we know that what can happen in 90 days is the tariffs can be on again, off again. He's very mercurial with these because he's still accomplishing whatever he's trying to accomplish. And I still contend that one of the major goals of his first 130 days is to get these bloody tax cuts through and this debt ceiling raised. We can talk about the drawdown of more spending. I think they're up 135%, year to date, whatever. It's ridiculous. This is all very, very damaging for credit, the US, and also our treasury market. But that aside, it's also very, very damaging to the economy and the market if he can't get these tax cuts through, because if he does, it's net, it just washes out. We already are used to them. But if he can't, then it's a tax hike. And we have tax hike on top of everything else that's going on. It's obviously, Goldman will be back in a New York Minute saying, oh, okay, recession's back on. So we have to get through this event. Tomorrow we have jobless claims that could also percolate higher. We have, rising yields, which is going to make it harder for the Fed to cut. But in an emergency, last night I was calling for, guess what? Not only is my Powell capitulation call so back on, but it's probably not even going to be 50. It's going to be more. So we're going to have to kind of, yes, absolutely. So I wrote all that for clients, but the point is we have definitely a stay of execution. That's all we got. And big picture, it's still dangerous. So we got to get through this weekend too, because that vote, if it passes, market can also embrace and go, we dodged another macro event risk. If it doesn't pass, what next? So we're going to have that to deal with. That is another risk we have to be talking about because the moves are 15% intraday. This is not normal. Investors will get worn out, shaken out, and basically you got to hedge everything. So I suggest just throwing some calls, because this is what happens. Don't get rid of your hedges. I still think we have danger ahead.
You can play the upside, a little bit more upside, right? Okay, so now we're sort of staring at 3 weeks in the face, right? So that's part of why I sort of said, listen, this market's closing on the highs. I wouldn't get in the way of this because this is a big relief from where we are. Remember, markets kind of perform at the margin. That's what I always kind of remember the saying that somebody gave me years and years ago. And it's true. There's just been a very, very big marginal shift in what's going on out there. So maybe we have a little bit of upside here where, all the talking heads are going to say, wow, what a great turnaround. This changes everything. So maybe we get a little bit of a push into, I kind of see that sort of 5,600 areas as a sort of supply zone where there's a whole bunch of stuff that went on there, as well as really a market that's kind of trying to get a little bit expensive again, as it was expensive at 5,000. I think if you have the chance to kind of lighten up a little bit up around there, or at least, maybe look at some hedges, you could, there's a good old callers that with implied volatility so high, you kind of have to finance that downside with something, in my view. And so you could go out. I was looking at something I recommended to somebody today. I said, give it another day maybe, and then you could kind of get in there, maybe do some, if you want to just create some income, you could just do some upside bear call spreads. You're getting probably $3 for a $10 spread, $3.50 for a $10 spread. That's pretty far away, right? So what happens is in these high vol environments, you get nice premium for quite distant structures. So you get a little bit of, as you should. I mean, markets, like you say, are moving around 8, 7, 8, 9, 10% a day. This is unusual. This will calm down eventually, but with these kinds of moves, really VIX 33 is kind of warranted. I said that even VIX 45 isn't. I mean, that's 3% a day. 48 is 3% a day.
But this is actually part of my thesis when I updated on this this morning, right? So I had my 2 a.m. post, and then I had a 9 a.m. post, and then I had a 1, and then a 2. Like, this just keeps moving. And what I wanted to say was this whole regime that our capital market is based upon is low VIX, right? Or suppressed VIX. So 10, 20, 30, we're not used to operating in a VIX in this up to 50. And we're definitely not used to VIX operating over 50 for a sustained period of time. Now, I quoted DataTrek, which basically said, I can show it to you, but basically this is like a 0.8, less than 1% occurrence, long story short, to have this type of sustained volatility. And it is definitely, I believe, the year that we're going to have. I think we're just going to have volatility, as I mentioned from the beginning, and we'll have waves of it, and then it will come back down, but we'll base at a higher level. And then we'll have waves of it, and we'll come back down, and we'll base at a higher level. So far, that is working to plan. So folks that are getting, excited about buying this dip, and I want to just show something real quick from a tactical standpoint, which is this. This is SPX. So this was the level, first and foremost, that I had given clients way back in January. I said 4,800. So everyone has their 75 or 7,000 hat. And I said, no, remember my article, no 7,500 hat for me. No, no, no. So that happened to be right here about 6,100. Anyway, I have 4,800, which, by the way, I have now ratcheted lower. I can absolutely see an overshoot to 4,000 this year. No question in my mind. But for right now, this 4,878 was perfect support that we got. Now,
yeah, you called that. I remember that. You sort of mentioned right around, that was pretty amazing.
So 48.78 was key. Now, the problem is this candle looks amazing. If this was a Friday, I would say, guess what? We're going to pull back down to 52.65 and we're going to start to move higher. But it's not Friday. It's Wednesday after close, and we have jobless claims and all day Friday and weekend risk. And there's no way you're going to convince me that we're going to close up here. So it would not surprise me if we see this 52.50. I today said, if we can get back above, I'm going to show you, it's really, really messy. This right here, this level, 52.50, if we can get above, now before I had already let clients know that this was coming, but the point is, if we can get above 52.50, we're going to go to 5,400. We overshot it. Like 54.51 was an overshoot. I think that's a little bit too much too soon. We went from a 200 day, which is a perfect tag, my 48.78, which is a perfect tag. This was the resistance level. Once we got above that, we were good to push higher into 5,400, but that is just enough. I think we're going to come right back down, and tactically speaking, it is now above 52.50 or below 52.50, but that is just tactically speaking where we're going to be this week. Where we close, however, on Friday will determine my next call. If we close below that 52.65, it's bearish, period. All we've done is made a fake breakout fast failure. All we've done is make a fake breakout fast failure. We're going to go sideways for 3 weeks until we get through, options expiration and as we head into earnings, and then we head into the Fed meeting on May 7th. So, and if we break 48.78, you're going to see an emergency meeting and Powell will capitulate. That's my baseline bet.
Well, and I think that's what people were worried about. And I thought things get a little bit ugly after yesterday. We came in, wasn't too bad. We were down maybe 60, 70 points, and then we stabilized. Then we had Jamie Dimon and Besant. I think was that they were, I don't know, the two of them, I think, were there. And so we kind of calmed nerves a little bit. And then, of course, the day went on as we've described. But, you've had so much foreign selling of US. You've had all this money leave. It's hard to believe that that's going to just suddenly reverse because, tariffs got delayed. So there's something's afoot here. I don't think there's any reason for us to get excited about, heading to all-time highs. So as I said, I think this is is sort of an opportunity. And I think you're kind of agreeing that this is a time to sort of thank your lucky stars and say, well, listen, this is a chance for me to kind of reconfigure my portfolio a little bit. If that's what you do, right? If you just buy stocks and hold them for 10 years, then whatever, plug your nose and do what you normally do. But if you're a trader, especially, it may be time to be, to take this gift. We got to the point where I had not seen, I was looking at some downside skew charts that were out of this world. Every single stock I looked at was like a parabola on the put side, right? So put skew being those puts just going bananas versus the calls, and looking out and around in Russell and other, especially Russell, and even other index structures, there was some really, really cheap upside. So that was kind of everyone focusing on the left tail, forgetting about the right. And so that's kind of playing out. So I wouldn't be surprised if we get maybe a few days of this, maybe a little bit longer. As I said, we've got 3 weeks till the tariffs for people to start getting worried again. But for now, there may be a little bit of unraveling of that heavy, hedge funds were getting short, all these sort of structural things that we talk about, these CTAs and vol targeting. There's a lot of stuff going on, right? So a lot of stuff underneath the hood.
But it's hard to get a lot of market direction during an earnings season though, too, isn't it? It's really tough. So let's go back to a question. I didn't mean to get you off track or trail, but it says, Hans, please complete your thoughts on hedging. I interrupted you.
Yeah. So if you own the SPY at this point, I said to a client today, I said, give it a day, maybe two, and then you can start getting in. Maybe if you're just kind of an income trader, you're looking for opportunity. But like you said, we've got these ranges. I had somebody ask me, is it a good time for iron condors? They asked me a few days ago, and I said, the ranges are just too big, right? So remember, sometimes you got to remember that volatility is sort of a relative value product. Sometimes a VIX 15 is really, really expensive. And sometimes a VIX 31 is actually quite cheap. And so I said, there's just too much going on. These moves are too big. I need to see, what I like to do is look at historical volatility charts. Everyone focuses on implied volatility. They've got their charts set up. What's pricing doing? Implied volatility is an opinion. It is sentiment. It's the market's best guess of where volatility might be. Historical volatility, what we also call realized volatility, is something you can also chart. That's your reality. That's what's going on. You could look at ATR, you could look at Bollinger Bands. This is the reality you're living in. And we have seen some of the widest ranges we've seen in years and years and years. And to me, even with VIX, even with option pricing really high, that kind of underlying movement just gets me uncomfortable. I don't care how much vol you're giving me, how much pricing you're giving me. That makes me uncomfortable. And sure enough, any vol selling strategy just got completely destroyed at the end of the day, like an iron condor. So these moves are too big. What I like to look for is a relaxing of that. I like to see things stop, kind of pointing straight up and kind of turning over a little bit, and some semblance of calm returning to markets. Of course, there's no guarantee it's going to continue. Maybe we go for round 3 and 4 of the next leg down. But I think, at this point, I'm not super excited about getting in the way. So protection, I think you can kind of keep it simple. I said, look, you own some SPY, you could get in there by tomorrow. Maybe you can sell a July. What am I looking at here? Oh, I'm looking at Netflix. That's not good. That's the wrong stock. Although it had a nice run. You were right, Samantha. It did crack hard with everything else, and we got down to 825 on my beloved Netflix, and we had a nice rally back today. It's funny. I was talking to a mentoring student this morning, and he was nervous. He was saying, "How do I go about thinking of buying?" And I said, "Listen, think of it this way. He liked Tesla, and he was looking at a really smart guy, knows so much about tech, and he said, I love Tesla. He was telling me about the robotics and all this stuff. He said, you have no idea what's coming with Tesla. And I said, terrific. And I said, well, look, you could sell maybe a 200 put going out 35 or 40 days or whatever it was. You could grab $15. I said, the problem with that is we're in a market where we could go up 700 points. We could go down 700 points. You're not really getting compensated. It looks like a good amount of money. It was maybe, whatever it was, 7.5% of the underlying value. I said, you could, if you really like Tesla here, you can sell that and grab $15, but you may be giving up. If you truly think this thing's going to go up $100, maybe pick up some 80 delta leaps, like some sort of in the money. And he'd already been doing that. And I said, and then sure enough, by the end of the day, you may have collected that $15. Tesla ran $50. So that's your difference in a market where you really have a lot of movement. You always have to kind of weigh that. Well, geez, these premiums look good. I could put $7 in my pocket, but if I really love something, am I going to leave $50 on the table? So you always have to, especially when things have been pushed down so very hard. I always try to get people to think in those terms because we get kind of stuck in the noise and we kind of want to nickel nickel and dime a little bit. No, I'm going to grab a little premium here and there. Think of the big picture as well. If you truly think Tesla's got a move in it to 450 over the next year, then make sure you position yourself more appropriately for a move like that.
I think this is the problem, though, is that the stocks that have been down tremendously, like Tesla, didn't move very much. And now they're going to attract the bulls because they've already been down, right? Whereas Netflix really hasn't done a proper rollover, in my humble opinion. But the point is, if the market backdrop supports it, stuff goes up. And if it doesn't, it goes down. But in this particular case, Tesla is a broken trend. So a lot of these Mag 7, the concentration risk unwind was outsized. And so they're going to have reflexive bounces. But they're broken. They're broken.
Yeah. So it could be 220 again 2 days from now. Exactly.
It's already 272. I have a price target of 180 on this. So we're talking 100 points lower, but I can absolutely see it rising another 50 points before it reverses back down to 180. Yeah. So this is the market we're in. Massive volatility. In both directions.
Well, I remember being short some 350 puts and I didn't cover them. And I thought, or sorry, there were 310 puts and the stock was 350. I didn't cover them. And next thing I know, the stock's 270. So you're really kind of living and dying by the sword with these stocks. There's when underlying realized volatility picks up, really you're getting run over almost not any option pricing, but it's quite easy to get run over. So you really have to wait. I like stability, and I like to look for stability to return. Today's a good step because we're a VIX 52 now down to 33. That's a good step in the right direction, but I think it's far from what I would call stable. So for me, other certain kinds of strategies are not in play for me. And I know there are lots of option sellers out there who just love to sell super high vol. It's been a difficult one. Goldman put out a chart the other day. I'll find it for you in a moment, but it showed how poorly put selling has done lately, as you would expect. This is not a news flash for people, but it has been horrific to do. To the question, finally, you could go out and you could look at selling, like by tomorrow, maybe you could sell a 580 call. If we pop $5-10, maybe you could get $12 for something like that, $12-13 for something like that. You could turn around and use that to pick up like a 530, 575 put spread, something like that. So you're basically what you're doing is you're JPM collaring your position, right? You're doing exactly what they do, which is they look for a put spread, they figure out what it costs. If it costs them $12, then they look for the call to sell that pays for that put spread. And so you're kind of creating, now you can be more aggressive and you can say, well, I don't mind spending a little bit. So you can use that call to finance, but even spend a little more on that put spread to give you that extra downside if you are particularly nervous. So that's a very, very easy hedging strategy that you can use, in a Microsoft, in any single name really as well.
Getting a question, Robert, my level for the S&P by Friday, bullish above, bearish below on the close is that 52.65. So that's what I'm looking for. I think it's going to have a really hard time staying up tomorrow. Let's put it that way. And then we'll see what happens with the House vote, both chambers and the whole bill, reconciliation, debt ceiling, that kind of stuff, and jobless claims. The question T is asking, Hans, where do you see VIX and OPEX landing? And PQ is asking about SVIX. Premiums reasonable for April 17th or 25th expiry. I don't do SVIX, so this is all you.
SVIX. Somebody asked me about it. Well, they asked me about SVXY, which is the half version, right? So SVIX
I love. This one I love. Yeah.
Yeah, you like watching those too, Samantha.
SVXY is a fabulous one, but not SVIX. So
yeah, it's had a tough run. And so these products, you have to keep in mind, these products are based on the VIX futures, right? So they're trading, they're benefiting or getting hurt from the roll from that front month to the second month. They're constantly rolling for the positive VIX products. These particular ones we're talking about are the short VIX products. So they are going to benefit from when there's calm, right? So the sort of 84% of the time, historically, when the VIX is low, the VIX futures are in a nice contango, everyone's in happy land. And that's when these really, really enjoy that structure. There's a very specific structure that exists a good majority of the time. So they are not really directly related to the VIX, although the futures are related to the VIX. So it's kind of a little bit of an interesting three-way relationship between these things, VIX futures, VIX, and these products, roll yield in there. So basically, yes, you can typically they are going to do well when there's sort of this boring roll yield destruction happening, and that benefits them. In this kind of market, you can make money in an SVIX and an SVXY. It's not going to be the boring part. It's going to be very quick spurts that come from a resetting of volatility. The VIX futures curve basically coming down, you're going to make quick money. So I always say, know your Greeks. Your Vega is usually quick money. Theta is boring, paint, dry money. So now we're in that Vega stage. So I would say they're okay. If you truly think that we could have a little bit of follow through to the upside for a few days, I think you can make a trade in here. It's tough to say because it depends on how the VIX futures react and what happens to the curve. So it's hard for me to give you a price target. I mean, you can kind of chart these. I know you like to look at them. Maybe around 40, 41 might be a place that I would target, but I'm not sure I would fall in love with this trade at all. This is a rent the trade.
Always.
Do not own this trade, because if we continue to have volatility, that is what hurts these things. Volatility hurts 3-time levered products like SOXL and all these things that people love to trade. Volatility up and down hurts those products. Volatility hurts this product. There is an embedded amount of money that is gone forever in these products. If you notice, these have done very, very poorly over the past 6 or 8 months with all the volatility out there. So be very, very careful with these and understand that at the moment, they are structurally at a disadvantage with the VIX curve the way it is. Having said that, if the curve comes down, you can make some quick money being long an SVXY or an SVIX. But this is not the environment really to kind of throw one of these necessarily in your account, unless you have a pretty strong stomach and you're going to put this thing away for 5 years, and then you should do fine.
All right. So a little option question on VIX next week, expiry. This typically helps VIX soften into expiration. We had this exact same play March 10th. And I remember because VIX was really elevated, and that was one thing I had said was, okay, 29.56 is what VIX hit. It didn't even hit 30. And we had already pulled back, I don't even know what, 10, 12%. Then, of course, April 2nd, the tariffs came in and we pulled back another 10% in SPY I'm talking about. So basically, we had a situation where this options expiration in March was very, very helpful to support stabilization in the equity market. Literally on the 10th, it was done. And 11th, it started to soften, into VIX expiration the following Tuesday, I think it was. And then we got busy again afterward. So now we have VIX expiration next week. We have options at the end on Friday. Next Friday, this coming is JP Morgan, isn't it? Don't we actually have earnings starting already on Friday?
We do, yep.
Oh my God, that's right. I'm so off because I've been so focused on Trump ascent and drama on bond market. But basically, that is very, very supportive, typically for equities. Very supportive. VIX comes down, equities stop falling. They can do sideways, by the way, for the next 2 weeks in a 400-point range, maybe a 500-point range. So that's my baseline bet.
There's just nothing's really been solved. I think we've just kind of given we've been given the indication that somebody might care a little bit, but nothing. And I suppose maybe there's been he's alluding to the fact that, look, okay, let's negotiate. I've had 70 countries call me. Look, let's have a chat. I don't know why he has to do things like that. These guys, all 3 of them, just come out and just say, they're very defiant, and we're barely going to pick up the telephone.
We cannot ask the question why. We just have to. How are we going to react?
Yes, it's the art of the deal.
My psychologist tells me.
Now I'm looking at this VIX futures curve, and so this is what I'm talking about here. You have this roll. Basically, you're kind of buying something. You're selling it at the wrong price. Basically, buying it high, selling it low, and you're kind of typically under contango. Right now, the long vol products kind of have the upper hand right now, right? Because they're doing the opposite, and these futures are, in theory, collapsing upwards towards the cash, right? On VIX expiry, the futures move towards the cash. So there's sort of an embedded kind of advantage to, let's say, for example, upside call spreads in VIX, or upside call spreads in or something, or even owning something like a VXX or something like that. There's sort of like, as long as this structure is in place, that is where the advantage is, not the other way around. It's a disadvantage to be shorted at this point. But having said that, we did see the curve come down. That benefited SVIX and SPXY, but we can see that this shape is really not much different than it was yesterday or the day before. So this picture, while the whole thing has shifted down and we've taken some fear out of it, the shape isn't particularly interesting. So how could you interpret? I think given that maybe we have a few more days of potentially of a little bit of a rally here as some of the real bearishness and shorts unwind a bit more, maybe you could make a little bit of money in those products. But as I said, this is not a great picture. So for the VIX, whoever it was, Patricia, I think it was, that's a really, really tough call. I mean, you could look at the chart here. You know, what's it worth? I mean, the VIX, I think probably, when is it? Tuesday? When's VIX expiry? Tuesday. I think, you know, we probably get into the high 20s, something like that. And then hopefully
if we break 30, I would be surprised. For sustainability, I'm talking about like coming back down to 31, 30, 29 and a half. I totally expect that for VIX. But I think it's going to have a hard time breaking 29 and a half and staying below, which is what we really, really want, right? This is what bulls really, really want is for VIX to get back below 30 and stay there. I think it can go there for a few weeks and stay elevated and continue as we work out what's going on with the main plumbing over there in the bond and the treasury markets. So
echoes. There's going to be echo. We're going to get echoes of volatility. Don't expect this to happen all in one fell swoop. And especially with a backdrop. This isn't just, you know, Powell at Jackson Hole saying, oh, you know, saying the wrong thing and markets, you know, swoon and then figure it out and recover. This is an ongoing problem. CEOs are going to be like, they're still going to be like, I don't know. What do you want me to say? I'm not sure where things are going at this point.
And CEOs are not going to be making plans for CapEx around spending billions into, you know, buildings and projects and people with this on again, off again tariff nightmare. So there's no way to plan.
Yeah.
But,
no, there's no way to plan. Right.
But to your point, we definitely need some stabilization, and that's not what you and the audience are looking for us right now.
No,
yes, is what we're telling you is this is a wide range where we have got to now compress from this wide range into a smaller range, and then from that smaller range we can move in a direction up or down. My bet is it's going to be a few weeks. So, and when we still
I would say a few weeks before we get a little bit, you mean as we go sideways a little bit in a bit of a range?
No, before the range starts to get smaller. We're in a massive intraday volatility range, right? And this has to calm down and compress before we can actually get a durable direction. And in all honesty, the question about have buyers come in, well, today we definitely had a bunch coming in when they calmed down, right, the tariff terror, and there's no question about it. But was it enough to change the broken trend? I have my sincere doubts.
No, I don't know. So, I mean, we could chart this, right? So maybe the VIX, you could kind of go, look, I think if we crack 30, we could get down into maybe 28 and a half. My guess is this isn't really going to look much different. In fact, this has gotten even a little bit steeper because it tends to flatten out a little bit when you get to VIX 50, 60. You know, that's natural, right? People kind of, it tends to do that. Down in the sort of 20s and in 30, we get a little bit steeper. So if the VIX pulls back to around 28, this is probably not going to look a whole lot different. I would say you're going to make a little bit of money on SPXY up move if the curve pulls down just a little bit more. But I would say that's an interesting time to probably start looking at reloading on VIX. I had some Aprils that I sold. I actually still have a little bit of May, but I don't care because that's a hedge, right? You have to kind of decide who you are. Are you doing this for alpha? Are you doing this as a hedge? I'm happy to see my hedge go down. But if we do get that dip below 30, I'll tell you what's going to look probably quite interesting is probably buying 31.40. Like I'd go maybe out to May. Yeah, I'd go out to May and pick up something like, if you want true full convexity to the upside, if you really think things are going to get really, really ugly again, then don't create a call spread. It's going to be, you'll do well on it, but it's going to create a little bit of a nightmare because that upside call is just going to explode. So I would pick up maybe like a May 31 call. By the time we get down a little bit more, maybe those are around 250, 275. And then you could sell 40 against it, a 42 half against it. So you could create maybe something close to a $10 spread, probably for not very much money, for maybe I don't know, maybe $1.60, maybe $1.50, maybe $1.70, tough to say, but that's pretty decent, right? For a $10 spread. Now you're not going to see, keep in mind, you don't see that full spread. Sometimes people look at that in the analysis software and they go, wow, I can make like a full 850 on that. That comes near expiry. So, but you'll still, you could sell something like that out at VIX 50, 52. You could definitely buy that for $1.50, sell that for probably, I sold one for $5 this week, I did sell some May call spreads, some of them, I kept some of them. So you could turn $1.50 into $4.50 very easily. You could triple that, maybe even get over $5 for that if things get a little serious again. So that's not bad. And and part of the reason something that like that still looks good is because VIX is going to probably still be a little high. The futures are going to be a bit lower, and you have this sort of what I would call a head start, right? Because the futures are going to slowly, you have reverse gravity with the VIX futures when they're in this picture. Reverse gravity means these are going to drift towards that VIX cash as long as VIX stays up there. Whereas when you're in a contango, you have gravity working against you. That upward slope just kind of hurts you on the roll, and it just kind of the whole thing just keeps coming down towards the VIX cash. So this is a long vol kind of market until further notice. So I wouldn't be afraid to strap on something like that.
I love that. This is a long vol market until further notice. Seriously, I like that a lot. All right, so I want to show a few things before we close, and I know we got a bunch of questions. We're trying to hit them without going too far over, but this is a chart that I put up early, right, when I was like, okay, I'm really alone here in this call, but I see recession risk pulled forward in the end of 2025. And I made that call, as you know, last June for end of 2025 and December for 2025. Now, this is very, of course, Trump tariff terror that is pulling forward, but there are a lot of other very, very instrumental, mechanical, plumbing type treasury drama that's happening underneath that we're not even talking about in this particular webinar. This is what I've written about. This is what Jeffrey is focused on. But my point is the effect is that Goldman, says recession risk is moving higher, and all these recession, goes from 0 to 30 to 50 to 60. And then they say, oh, we're in one, then they pull it back. Whatever. They're going to be trying to figure this out. But one thing that is very kind of straightforward is this chart that I showed at the beginning of the year where there was zero recession risk priced in. Zero. We were at 6150, and I said, by the way, this will come in handy. Just keep it as a bookmark. I put this on. Since then, as of Friday anyway, the EPS decline was 4.5 percentage points. So I took this kind of red column, and our PE multiple has gone down to 19. So 4,900, quote unquote, is that kind of fair value. Now we're going to get a feel right now, earnings season. Banks are starting, and I know we got a few questions about banks, and I'll show you a quick chart on banks that I have and my concerns about banks. But the big picture is this will be repriced after we get earnings. So they've lowered that bar week after week after week, and now they're going to have to, I'm talking about analysts, and now the companies are going to have to beat, and very few are going to want to give guidance, and the ones that do, that are positive, will probably be showered with gifts, right? Because everyone's looking for where to put money and hide out and be safe. This is something that I want to remind, though. Goldman came out, speaking of which, and their range was so whacked from 5,900, which, by the way, they ratcheted down whatever their year-end target was. I think it was 6,900 plus 5,900 all the way down, which is crazy, to this quadrant, down here.
I think they've moved it twice, haven't they, Samantha? I think they moved it twice.
They move it intraday, like we.
Yeah.
But this is what I want to highlight. It isn't Goldman's thing. It is the fact that I found this chart and I thought, no, this is really what we need to be focused on. Recession risk pulled forward is perceived. Actual recession would be very real. So we can unwind a lot of these prices that have happened in the past few weeks if perception turns around. Once we actually trigger recession, not so much. And one of the things I want to highlight here is what happens typically to EPS, since we're going into earnings starting Friday with JP Morgan. Well, we have about, on average, a 15, median is 15, sorry, average is about 19% change in EPS. I just showed you a chart that I grabbed from DataTrack the beginning of the year, and I bookmarked this. We're already down to 4,900 on a 5% decline. Okay, Hans is like,
I'm getting it.
You're getting it. You're getting it. We are just starting.
Just starting, yeah.
We're just starting. Pace yourself. We're just starting. Anyway, that's all. I don't want to leave on that note. I just want to say Come on, nobody was pricing in recession risk. I was. And now we're right down here in this 4900 area. Now, of course, I know we bounced blah, blah, blah. But the point is, you know what I mean. We hit that 48.78. That's 4,900. And this is what we have to look forward to if real recession triggers. So just kind of keep that in perspective. Keep your hedges. Have fun chasing if that's your thing. But really, we have lots more to go, especially at the macro level. Just thank God. Seriously, we've got such a fabulous team. I mean, my DM was blowing up. Your DM was blowing up. Jeffrey, the whole team is like fielding questions and helping, actively support clients. Some are hurting. Some are really well positioned with kudos because we've been very, very attentive. And this is going to, unfortunately for us, because we're exhausted, this is going to continue for a little while. This doesn't go away. This is something that may not be your style. Then zoom out, raise cash, watch from the sidelines. I mean, you even tried to get in on Monday to add hedges. Forget about it, right? You could drive a truck through all these spreads. And this is the problem also with options, where it sounds really good if you time it well, but then you still have to get out. And liquidity has been so poor. And I keep writing about this. Liquidity sucks right now, not just Fed liquidity for the whole market, but also the option market and the dollar market and the rate volatility market and the FX volatility market. This is the problem when you want to actually get out. So if it's too big of a position, lighten up. If it's too close in duration and you're going to get whipsawed by the stuff that happens today on a Besant tweet and a clear market manipulation post by Trump, then this is not the game. It's too disruptive to your, emotional capital. So it's both, right? You have to safeguard your emotional and your financial capital. So hopefully that somebody needs to hear that. But pace yourself. This is definitely early innings. We've got a whole year of volatility, in my humble opinion.
Yeah, I had a friend have a nervous breakdown yesterday. So take care of yourselves. This is not easy. It's funny. Sometimes I get people like prospects for mentoring, things like that, and they say, my job is just so stressful. I want to just trade all day. And I say, that's interesting, because trading can be stressful too. You think you're stressed out now? So yeah, make sure you're kind of staying within yourself and don't get distracted by all the noise. There's a lot of that.
And don't be suckered into just one narrative. Trump is mercurial, totally caving. I don't buy that. I think he and Besant both knew that they have done damage to the bond market and they're pulling forward credit risk. I actually think this is a short-term salve. It is not going to fix the problems. And I don't think tariffs are done at all. So I'm still on record with this. Nothing has changed for me. Nothing has changed for me. But intraday, it looks like everything has changed, but is anything fixed? Like you said, it's still a long volatility trade. It is. So just kind of, hopefully there's some perspective there. Anyway, thank you all for attending. We'll be back here next Wednesday. We'll see what happens. CPI, jobless claims, the debt ceiling and tax cut bill, more tweets from Besant, and more tariff retaliation. By the way, all that is very tradable still. And we'll be here for clients, and we'll be here next week for you at 4:00 after the close. Thank you so much, everyone.
Thanks, guys.
Bye.
Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.